So, hello and good afternoon, everyone. I am Mahdi Qudsi, and I am an economist from the Vienna Institute for International Economic Studies. Welcome to today's event with the title Growing Imbalances of Cross-Border Investment Incomes, a Fault Line in the Eurozone. And today's presenter is Konstantin M from University of Groningen in Netherlands. And this event is part of the series of seminars in international economics, which is organized by the Vienna Institute for International Economic Studies in cooperation with Research Center in International Economics, or FIW. And seminars in international economics are intended to be a forum for presentations and discussion of current research findings in the field of international economics, and which are majorly focusing on three major topics: international trade or trade policy, foreign direct investment, and migration. And in order to do the housekeeping, usually the event starts with a presentation of about 30 to 40 minutes, and it's usually followed by a discussion of about 20 minutes. So before I talked with Konstantin, and his way of presenting is like he makes some pauses in the middle of his presentation so that if anyone has any question, he or she can unmute herself and ask the question exactly during the time of the presentation. Or as we do it conventionally in other webinars, you can also write down your questions in the chat function. If the question is very important and needs to be answered right then, I will ask Konstantin to answer the question. Otherwise, we will keep the question, we collect the question, and they will be answered in a moderated discussion after the presentation. So we will have a Q&A session afterwards. And also after the event, there will be an online survey which will be sent by email to all of you so that we can receive your feedback and evaluation so that we can improve this series, and also we can send the evaluation to the speaker. And another important note is that we are recording this webinar, and this webinar will be available on YouTube channel, on the VV YouTube channel, which will be available, I think, a few days afterwards. And slides that Konstantin is presenting will be available on the VV website, on the website of the event, and the paper, we hopefully will receive it in a short period of time, and we will upload it also on the website of the event. So in order to introduce Konstantin, he is an assistant professor at University of Groningen in Netherlands, and he has worked and consulted the World Bank, the International Monetary Fund, the European Central Bank, UNO wider, and Austrian Central Bank. And his research investigates questions of macroeconomic development and globalization, particularly foreign direct investment and export quality. So, Konstantin, thank you for accepting the invitation. The floor is yours.
Well, thank you very much, and thanks to everyone who's joining. This research is actually, I should mention, part of a central bank project from the Austrian Central Bank, the Klaus Liebscher Economic Research Scholarship, which has just an open call right now. So if you know any person that is interested in applying and doing like a central bank-ish kind of work, feel free to let them know. The research is on cross-border investment income flows, and that sounds very technical, and to some extent it is, but it's also very important, as you will see, and as it will be a key part of my talk. But let's clarify details. What do I mean by cross-border investment incomes? These are income payments for cross-border asset holdings. What does that mean? Suppose an Austrian national or an Austrian person holds an asset in the Netherlands, right? So, for example, I'm residing in Austria and I'm holding shares in a Dutch company. Then I get some dividends on those shares, right? And those dividends are an outflow of incomes from the Netherlands towards Austria. And this is recorded in the balance of payments, particularly in the current account. It's a sub-account of the current account, which we call the primary income payments, right? So what does this mean? An economy has incomes from abroad. This could be labor income, or it could be income from capital abroad. Okay, so this is the wider concept, and I'm focusing here on the income revenues that come from these cross-border investment holdings. And because their income flows and part of the current account, that means they contribute to current account imbalances, right? It's just that not many people talk about them, but we'll see that they're very important. Okay. Sounds very technical, but you can also think about it, and that's I think what makes the topic very interesting, that this of course shows us a picture of how wealth is internationally distributed, right? If a country like Austria, Germany, the Netherlands is receiving a lot of primary incomes from capital, like investment incomes, it means they hold a lot of assets abroad, right? Whereas many countries in Eastern Europe, there's a lot of outflows of these payments, and that means that they have a net debt position in international investment markets, right? So this is the type of flows that I'm talking about in today's talk. Just quickly also, where do they come from in the first place? Because I think that's important also to remember or to have in mind. There's two ways for these flows to build up. The first one is through exporting. So if Germany exports a car, right, to say the US, then Germany receives US dollars, and these US dollars are an asset. In the case of a US dollar, it doesn't bear an interest. But for example, Germany could then invest those dollars in US Treasury bonds, and they would create interests, and these interests would be income flow from the US towards Germany, right? So one way of establishing those international investment positions is exporting. The other one is just exchange of financial assets, right? So it could be the case that I'm buying, or say someone in the Netherlands is purchasing an Austrian government bond, right, for 100 euros. And the Austrian government bond essentially has no interest rate, so there's no income flow. And with the 100 euros invested in Austria, an Austrian purchases, for example, a share in a Dutch bank, right, Inkdiba. And this share pays a dividend, and then we would have, right, I mean, that's an interesting situation because we have 100 euros investment from the Netherlands in Austria, 100 euros investment in Austria and the Netherlands, but in that case, only payments would flow from the Netherlands to Austria because the Austrian investor in Inkdiba would receive interest payment, whereas the Dutch person investing in Austrian treasury bonds would not get any payment if the interest rate is zero. So I also put you the according balance of payments identities here. But yeah, so this is what we're talking about today. And I want to just also ask you if the concept so far is clear. If not, then this is a very good part, I think, of the presentation to jump in if you have not understood anything here. Basically, as I said, we're talking about the revenues that a cross-border asset generates. These are called investment incomes in the balance of payments and are recorded in the current account. Are there any questions related to that? If that's not the case, then let's jump on. And I want to show you how important, right? I told you that these investment income balance. So if you think of the current account is essentially the trade balance plus the income balance. No? And in the policy discussion, we very often talk about, so for example, we talk about current account imbalances, and we think of, for example, Germany running a lot of current account surplus because of their trade. We think like, okay, Germany is exporting a lot, and that's true. But as you can see here in the second column, Germany is not only exporting a lot, but it's also gaining a lot of investment incomes, right? So about a third of the German current account surplus is actually coming from the fact that Germany holds a lot of assets abroad, and these assets generate profits and dividends that are being repatriated to Germany, right? So this would be recorded here in the German current account, and we can see for Germany that's substantial, but it's even more substantial in the case of Japan, that historically has run way more current account surpluses in the past, right? So you see, and I'll show also in the next graph, how important these incomes are for Japan. An interesting case also I want to mention here is Eastern Europe. I give you here just two examples, Poland and Romania, but it looks similarly for several Central Eastern European countries. You have it the other way around, right? So these countries have a current account deficit, which is mostly driven by investment payments, right? By the fact that a lot of, say, German, Austrian corporations invest in Eastern Europe. And then, of course, this creates profit repatriations to Germany, Austria, Netherlands, wherever, right? So the main story here is in the current account balance, investment income payments are very important. And for some countries, of course, it gets very crazy. And let's think about that. Ireland, right? In Ireland and in Luxembourg, we're talking about the fact that the investment income balance is a negative 20% of GDP. No? That's an enormous magnitude, right? Whereas these countries still manage to run a small current account surplus, or in the case of Ireland, a small deficit. But where is this potentially coming from? It's coming from intangible assets being invested in Ireland, in Luxembourg. Also, you see the position is quite negative usually, or has a negative gross aspect in the Netherlands, even though things balance out there. Where is this coming from? So multinationals invest there in Ireland, for example, but have huge, in patents, for example, but have huge profit repatriations, right? So you can see these potential profit or tax optimization strategies here really very clearly also in the investment income balance. Sorry. Yeah, so here's the case of Japan. You know that Japan has run historically a very high current account and trade surpluses in the past, and was a lot of concern for policy disputes in the, I don't know, 70s, 80s. And you see here also as a percentage of GDP, you see again in red the current account balance over time now, and in blue the investment income balance. And there's two messages I want to take you away from that. First of all, or three, the investment income balance is important, right? It amounts to like 10% of GDP. We've seen that in the last graph also. But essentially for Japan, right, which has built up huge investment positions over the past, the current account currently is the investment income balance, right? So you see that over the last couple of years, these things like perfectly move together. That's the second thing. So it's important for the case of Japan. It's mimicking totally the current account. And the third part that you'll see also later on is that, for example, during the global financial crisis, the investment income balance tends to be more stable than the overall current account. Why does that make sense? Well, you have cross-border asset holdings, and usually, because many of them are in the form of foreign direct investment, they're relatively stable, right? Whereas trade flows, we see that now currently with Brexit, Corona, during the global financial crisis, also trade flows are more, there's more scope for adjustment, at least at the margin. Right? That's why the current account balance overall, or the trade balance, is more volatile or more flexible, you could call it, than the investment income balance.
Sorry, Konstantin,
yes.
Can I jump in?
Absolutely.
So current account balance includes investment income balance plus trade balance,
yeah,
plus net transfer. So yeah. And here it shows that the current balance of Japan is actually equivalent or the same as its investment income balance, right?
Yeah.
So it means that there is a balance in trade, and all of the current account surplus is coming from the investment income balance. Is it correct?
So of course the scale here also matters a bit. So you could still have like 0.3, 0.4% of GDP in the trade balance variations, right? But like on the scale we're looking at here, really like 90% of variation over the last years in the current account are just due to the investment income balance. And trade is, as you mentioned, trade is then essentially balanced, right, for Japan.
I see. Yeah. Okay, thank you.
Sure. So thanks for asking. If anything else is unclear or you have any other questions, please feel free to come in or to type it in the chat, and then Matti can interrupt me. Good, so I hope so far the topic and the relevance are clear. So far, we haven't looked so much at these issues, right? When we talk about current account balances, we think like, okay, these are trade imbalances, but the issue is getting more and more importance. If you look at the latest IMF Article 4s for Japan and Colombia, you will see that they look at the net international investment position and the income payments resulting from that for these two countries. There's a very recent paper in the Journal of International Money and Finance where they say, well, there's still a large, so they're saying, okay, current account balances have adjusted after the global financial crisis, but stock balances in investment positions have not, right? So which means, of course, that also income balances have not necessarily adjusted. There's a very recent paper by colleagues in Groningen in the Journal of International Economics where they essentially look at right, if you think of global value chains and the value added, then the value added, if I say a value chain where for a German car manufacturer, some parts and components are produced in Poland, then this adds to Polish value added, but actually the value added to some part is then transferred back in the form of profit repatriations to Germany, right? And basically, I would say that the paper by Timo and colleagues in Groningen is a technical way to account for that in a cross-border setting. A very interesting paper also. A recent paper in the Review of International Economics looks at the net outflows from emerging economies, also highlighting that it's driven mostly by FDI. So you see that there's a very recent interest in this topic. Why? Also because people start to realize that these profit flows, of course, change our picture, how we think about the welfare gains from trade. So there's a recent paper in the AER that allows for these profit repatriations and shows that for investment receiving countries, basically, so FDI receiving countries, then welfare effects of openness can be negative, right? And this is also then scope for policy debate, especially with respect to Eastern Europe. So just to give you an example here, this is from the blog of Thomas Piketty, where he talks about challenges in Europe. And you see in this graph, his argument is, well, there's discontent about Europe and about globalization, Eastern Europe. Why? Because even though these countries would receive net payments by the European Union in the form of transfers, which is the greenish bar, they at the same time lose kind of capital outflows due to profits being repatriated to Western European countries, right? And there's a lot of discussion about these numbers. But the way I read his blog is like not making this case very strongly, but like arguing why this is a challenge for European integration, why many people in Eastern Europe think that way. And Andrej Babiš has brought up this point, or in 2010 in January, Viktor Orban has said essentially, well, there is no aid flows from Europe to Hungary. Hungary is actually paying to the rest of Europe. Because of these profit outflows, right? So there's a huge policy debate to that, and that relates to this international inequality in wealth that I was referring to in the beginning. So really a topic I think that has quite substantial policy implications. Good. So what is the hypothesis here, or why do I think this paper is addressing this topic is interesting? First of all, because from a stability point of view, or for an imbalance point of view, I want to understand, well, is this a potential problem in a Eurozone or in a currency union more broadly, right? Why these IMF Article 4s, for example, they look at how these imbalances, these income imbalances are affected by movements in the exchange rate, how fast the exchange rate can help to shoulder adjustments. And we know that, of course, in a currency union, you don't have this transition mechanism, right? You cannot, I mean, there's no working on the exchange rate to adjust for imbalances, right? So the hypothesis here could be that these imbalances are particularly persistent in the Eurozone. And related to that, it could lead along the lines of the Piketty paper or Piketty blog contribution, it could lead to some discontent, right? That people are disliking the European division of labor because it would lead to systematic outflows of some incomes from their countries, right? You can relate that in a broader sense to growth models that are balance of payment constrained. There's work by Thielwall in the late 70s, I think, and Roman and Michael Landesmann have recently also written a paper related to that in application of GVCs in Eastern Europe, right? So this is also what the paper therefore partly relates to. The paper is still in the making, so any comments are very welcome. What is the main contributions or the main takeaways that I highlight already at this point? These investment incomes are very relevant if we talk about current account imbalances. I think you have seen that so far already. And what I look at is, or the analysis I do, and that's mostly or throughout descriptive, right, is to highlight that these investment incomes are particularly persistent, but not particularly so for the Eurozone. So there's nothing to worry from a Euro perspective. And that their behavior differs very much from the behavior of other parts of the current account. And this is particularly the case in the Eurozone, okay? Which has quite some drastic policy implications, I think, because we talk a lot about current account imbalances, but if two major subcomponents of the current account move in opposite directions, it raises the question from an academic point of view, but also from a policy monitoring point of view, like, why do we talk about the aggregate current account at all, right? And wouldn't it be more meaningful to look more into the sub-accounts and also, of course, create on a global or at least European level the data that are important to do this job. Which brings us already to the first empirical challenge, which is investment income data. There is no global data source for investment incomes, right? There's primary income data from the OECD or the IMF, but not a detailed breakdown for investment incomes, particularly not on a bilateral level. But Eurostat has quarterly current account and GDP data that allows to separate the investment income balance. And this is what I'm using for the rest of this talk today. And to that, I merged two other countries, which are, of course, important. One of them is the United States, and the other one is Japan. Okay, so of course you could go country by country, but I want to focus here on Europe, and I just thought it would be interesting to see also the US and Japan in here. Just for you to understand the data, I decided to take the data not seasonally adjusted for the current account data, but to normalize it by seasonally adjusted GDP data. Why do I think this is the right way to go? Because then we have like we have a reference series which is not adjusted, and we could still see like quarterly fluctuations from the current account components. I mean, it's not that I'm talking about that a lot or that I'm particularly interested in it, but I think that's the most informative way to go. So when are these data available? That differs by country. I think Sweden has it back till the early 1990s. But for most countries really in Eurostat, that starts about 2008. Okay, so we have quarterly observations for about 34 countries starting around 2008. That's the data source. The first thing I'm interested in is how persistent these imbalances are, right? So what I'm looking at is either the investment income balance or the current account balance relative to GDP as a dependent variable. And I regress that on the previous periods or the previous quarter balance of the respective series. And that gives me the autoregressive coefficient. And the higher this coefficient is, the more persistent is the series, right? That's one standard way of looking at the persistence of a series. And then what I do is I have like seasonal dummy variables, and I allow for different trends, right? I mean, you can think of deficit countries and surplus countries having different trends. So I allow that surplus countries and deficit countries of the respective series follow different trends. I played around a bit with that, so that's not a very strong assumption here, or not very important. And you see so the first two columns are the investment income balances relative to GDP. The first one is without country fixed effects. The second one is with fixed effects. And then you also see the column 3 and 4, the current account balance relative to GDP. Again, first without fixed effects, and then in the fourth column with the country fixed effects. So what do we see? Well, we see if we compare column 1 to column 3 and compare column 2 to column 4, we see that the investment income balance is more persistent than the current account balance, right? That's, I mean, I am personally not particularly surprised by that. As I mentioned, these cross-border investment stocks are relatively persistent because most of them, or many of them, especially the high interest ones, come from foreign direct investment. They cannot easily adjust. So it means that investment income balances are more persistent, or are particularly persistent part of the current account. The question is that particularly the case for Euro area countries? And in order to address that, I was running the investment income regression, which is saw country by country. And then you get a coefficient for each country, right? So this autoregressive coefficient you get for each country. And then you can look how is that distributed, and that's displayed here. So you see that on average, the Euro area countries, right, which is the blue density, is lower than for non-Euro countries. What does that mean? It means that the persistence of income payment imbalances are, if anything, lower for Euro area countries, right? So it seems like there's nothing to worry about in the Eurozone in the sense that adjustment would be delayed or slower by the common currency. Another way to look at that is the following graph, where I look at the annual level of the investment income balance in 2011, right? So any country here to the right would be in surplus, and any country to the left would be in deficit. And then look how this balance, how the time trend of that balance has emerged from 2011 later on, right? So you would expect if we have adjustments of these imbalances, we would say that countries that are more in deficit, more to the left, experience a faster improvements in their investment income balances, right? So that would mean that they are more up here. And if as you move to the right, the more you move down, meaning that countries that are increasingly in surplus have experienced a worse or declining trend since, right? So this is like, it's essentially like a standard convergence regression. And you see in blue, again, the Euro area countries, in red, you see the non-Euro area countries. And I would say here, well, there's a clear, I mean, Ireland, of course, is a very particular case, right? But besides from that, I would say there's a clear downward slope, meaning that countries that were more in surplus in 2011 have had more negative trends since, whereas countries that were in deficit in 2011 had the more favorable or more positive trends in the investment income balance since. Okay, so there's signs of convergence of imbalances, and particularly, I mean, you could then play around with slopes, etc. But I would say there's no clear indication that euro area countries here behave differently or would not follow a convergence trend compared to the other countries. Okay.
But, sorry, let me ask a question, Robert.
Sure.
I mean, if I look at this graph and kick out some of the, say, outliers like Luxembourg, Estonia, Malta, Cyprus, which are strange anyway in this case of profit reshoring and so on, and maybe Belgium, then it would get a positive line, right? So, meaning, my question is whether Luxembourg, Malta, Cyprus, maybe Estonia are somehow outliers in the whole story, and then you don't get this convergence stuff.
Yeah, I agree. Yeah, of course. I mean, the sample is very small, right? I fully agree. It's not a very robust thing. That's also why I did not put the regression lines. But I would still say that compared to the other countries, I mean, there's no clear pattern, right? There's no clear pattern and nothing that sets the Eurozone apart. But you're right. I think this is something like to look at more clearly, like kicking out countries that are, for example, known to be aggressive tax planners, right? Also, I have to add here that, of course, 2011 is already, I mean, the starting year probably matters, right? I mean, 2011, we have seen quite some adjustments going on in many European countries since then. So I guess as much as the selection of countries probably shifts around the picture a bit, the start year also shifts it a bit around, right? 2011 was just, I think, a year where many observations started to be available. But I agree. No? Still, it's not like the picture I get from various ways of looking at it is there's nothing. I mean, there's no clear sign of divergence or no clear sign of a different pattern for the euro area countries. But still, I think like that should not leave us comfortable. I would absolutely argue that this is something important to look at, and look at it at the country level. Something which people have recently, or scholars have pointed out, is that across countries and within countries, the investment income balance is negatively related to the trade balance, which is maybe a bit surprising, especially between countries. What is the intuition for that? The intuition they give in their paper is that, you know, think of the standard macro case like Japan, and to some extent, I would say Germany currently is like you have an aging population, right? Whereas you age and you have a high labor force participation, we want to save for being old later on. You save in an open economy through exporting also. So you generate essentially trade surpluses, right? And then at some point you grow old, and if you grow old, you consume, right? So if you consume, it means you run a trade deficit, you're de-saving. And in order to finance that, you use the investment incomes you generate from your accumulated assets, right? So that's the standard explanation they're giving. In the past, of course, that has not necessarily worked very well, these saving objectives, especially for Germany. No, remember, in the past, always, whenever Germany was in severe surplus, that would put pressure on the ERM currencies and would lead basically very often to a appreciation of the Deutsche Mark and depreciation of other currencies, right? Anyway, I think this correlation is interesting to look at. What I find is that this is definitely something which is different for the euro area, right? So what you see here is so I regress the non-investment income part of the current account. So I take the current account balance and separate out the investment income balance, which you have here. And you see that the correlation coefficient is only significantly negative if you interacted with the euro area dummy. right? So this is the first one is a fixed effect. So you're looking at variation over time. The second one is a between effect estimation, which means you're looking at variation across countries, right? In both cases, the only significant negative correlation emerges from looking at euro area countries. But this, of course, in the next step, asks the question, why then do we talk so much, especially in the euro area, about current account imbalances in the first place, right? If we know that the current account is basically made up by like a trade-driven part and the part that is driven by these income payments, right? That's the main part, I guess, of the argument I want to make. So what I also look a bit into is like different drivers, determinants, or actually that just correlates with the current account, I would say, following up on previous work by Philip Lane and Giancarlo Milesi Ferretti. Chin and Prasad had a paper on that. So there's a standard set of current account determinants, right, that they use, which would be here on the left. And like, don't get lost in the details. I just want to like point out a couple of things. This would be now without the fixed effects. You see, for example, the like aging, so a country that has more is expected to grow old in 20 years or so. But let's look at like standard determinants, like for example here, savings, right? You see that the trade-driven part of the current account correlates positively with domestic savings, right? Which is a standard macro view that there's two forms of saving. One is domestic, the other one is by exporting, right? So they should go hand in hand, but they correlate differently with the investment income balance, right? Which means is exactly the argument I gave you before. If you grow old, you're saving less and you're probably living from your investment incomes. You have also similar here, domestic credit. You see, for example, if you only look at the current account overall, you miss that this is really driven by the investment income balance, whereas the other parts of the current account behave completely different. Also for broad measures of money in the economy, similar for the government budget. And this is something that also holds, for example, in a fixed effect regression, right? So you also see, for example, here for savings, different coefficients. You see it for domestic credit. I don't want to talk here about the details. My main point here is that if we look at the current account balance as a whole, we're actually confusing two different things that for a large degree work in opposite directions. Okay. The last point I want to look at is to relate to this debate about profit outflows, right? And here I look at different indicators of trade in value added, right? So that's addressing the question, okay, if I integrate more in value chains, does that mean that I have particular pressure on my investment income balance, or in that sense also the current account balance? So I look at several variables here that are taken from the OECD TIVA database. I talk about them maybe later on in the context of the regression results. So basically, I look at three types of indicators. I look at overall value chain global value chain integration, which is an inverse measure. It's domestic value added as a share of gross exports, right? The more domestically you add to exports, the less you participate in global value chains, right? Then I look particularly at this share, but only looking at the domestic service value added. Why is that important? Because this could be a proxy for intangible assets, right? I mean, think of the case of Ireland that I showed you previously. You are running a huge deficit that could be driven by services, right? Services that Ireland is providing, for example, within multinationals. And then I split up also the global value chain participation by backward participation and by forward participation. Backward participation would be the German case, right? That you source inputs in your German car from abroad, say in Poland, right? And the different perspective would be the Polish, typical Central Eastern European perspective, that you participate forward in the global value chain, meaning that you supply domestic value added to other countries which they use in their exports, right? So this would capture the part of Polish parts and components in German car exports. How do they correlate with investment income balances? You see that the more you participate or the more domestically you add to your exports, the more investment income you generate. I think that's not per se surprising, right? The more interesting part, I think, then starts with the different modes of integration, right? So what do we see here? Here, first, I look at the role of services. For services, it's also the more you add to, I mean, generally, the more services, service value added you have in your exports, the more income you generate from abroad. But this is, but not anymore as if you control for the overall value added, right? What does that mean? The most, I mean, it seems like a manufacturing value added or other forms of value added than services generally give you a higher income return to your exports than services, which are often correlated with profit outflows. That would be my argument. Okay. Here you also see the share of the services value added. You also see that creates pressure on your investment income balance. What again is the intuition from that? If you think of the Irish case, no? In the Irish case, you provide a lot of domestic value added in services. And generally, on one hand side, that's good for your investment balance because you have more exports generate foreign asset positions that could help you to improve your investment incomes. But at the same time, a lot of this foreign asset, if you specialize in services, reflects the fact that you're actually a tax haven working for multinationals, and they create a pressure on your investment income balances. That's the cases we've seen for Ireland, for example, right, in the first graph I showed you. Last word on forward and backward integration. So forward integration would be here. That would be like the Eastern European case. The backward integration would be here. That would be the German case. It seems, right, I mean, this would be the concern of countries in Eastern Europe is, and that's the policy debate, if we're not benefiting from Europe because we're participating in these European production networks, and actually they're repatriating all the profits. And of course, there's profit repatriation, even though some of these profits are, of course, reinvested. But there's also productivity gains and spillovers to local firms, and that creates additional export revenues and additional foreign assets, and therefore in the long run, additional investment incomes. And you see that the benefits from forward integration into value chains is essentially positive. Here in the second column, I have the country fixed effect where there's no effect. But if you look at those countries that are in the euro area, if you take the two coefficients together, you see that they're also benefiting, that countries integrating into value chain, forward integrating into value chains that are part of the euro area, in any case, benefit in terms of their investment income balance, right? So overall, of course, if you have foreign investment, it means that you have investment, that you have profit outflows. But the policy conclusion from that is not that you disintegrate, right? Because on balance, forward integration into value chains still leads to a more favorable investment income balance, right? So this is the way fuller picture than we have in many policy debates. I want to wrap up here. What is the key point I want to make? First of all, these investment income balances are very important to understand imbalances in the current account. So far, I've not found anything particularly worrisome in the behavior of these balances for the Eurozone. That does not mean that we should not care about those issues in the Eurozone, right? But I think we should care about them way more. And instead of, right, we currently have the viewpoint that we, in the European Commission imbalance scoreboard, we look at current account balances. And my argument would be we have to look at the income balance from a different perspective, right? I mean, essentially, this would only be consistent with what the European Commission is already doing with budget deficits, right? In the budget deficits, we look at the primary deficit, right? We look at this 3% target after striping out the payments on past debt, right? That's what the Commission is doing. Because I mean, that would make sense, because in the case of Italy, I mean, Philipp Heimberger has a lot of work on that. In the case of Italy, I mean, the interest payments are just legacies from the past, right? And what we're interested in from a policy perspective is what is going on currently. And if you apply the same principle to the current account, you have to strip off the investment imbalance. Why? Because this is just the interest payments on assets abroad, right? That you have accumulated over the past. This is not relevant from a current account policy perspective, right? We have to separate the two, and we have to look at them with different tools and perspectives. That also needs more data, especially in the European Central Bank. I think there's scope to really improve, especially on the bilateral level. And I hope this is the way also the bank takes forward. And here I'm stopping my talk, and thank you for the attention. And I think I'm mostly in time.
Thank you, Konstantin, for the brilliant presentation, and it was really good. I understood and I learned many things, and you also made some interesting conclusion at the end. So let's collect some questions, and if anyone is interested to raise a hand or ask a question, please feel free to first raise your hand, and then I can let you in. So yeah, the first hand is by Robert. Robert, please unmute and discuss.
Okay, thank you, Konstantin. Very interesting thoughts and perspectives to looking at these details of the balance of the current account and so on. A bit detailed question. I have been a bit puzzled now by the interpretation you gave to forward and backward linkages, particularly as you referred to the automobile industry. So in my perspective, it would be that Germany and Austria has some forward linkages to Eastern Europe, so sending all the motors, more technical stuff, whereas the assembly stage is taking place in Eastern Europe. So in my perspective, it would be like Western countries are the forward linkages to Eastern Europe, whereas the Eastern European countries have some backward linkages because they are the assembly countries, so to say, and compiling that together then in the end. I'm not sure whether well, of course, this maybe depends very much on which industry one is looking at, but I wondered whether this has some implications for your interpretation then. A related point, given the time dimension, as you said, that since 2011, this relationship's changed a bit. Meaning, I think there was, well, we know from the literature that this global value chain integration basically has been constant since the crisis. So this has been a period in the Eastern European countries to build up their own capacities as well. We know this also build up also motor production and so on. So that might be some of the part of the story why this has changed since 2011. But on the first question, I wondered whether what is your perspective on that?
Thank you, Robert. So maybe Konstantin, you can answer, and then we can go to the next question.
Yeah, so on the second question, I cannot really do much because, as I said, the time dimension is a bit limited. Thanks for the first one. I'll have to look at it. So far, this was my just clear interpretation that these countries are forward integrating, but you're absolutely right. I should probably look at, I mean, you're way more the expert on that than I am. So we should look whether that's really the case. But in my view, it would not change much. You see here, this is the backward integration. you see that's a negative sign, but not for the euro area countries if you take that on top. Right, because you have to take the regular term plus the interaction. So definitely the problem here is then not the common currency. But it's a good point. I can look at first which are Eastern European countries really those that are forward integrating, and second of all, I mean, one can look at if things look differently for that. I appreciate that comment. Thank you.
Thank you, Konstantin. If I pronounce your name correctly, Sidan.
Thank you, Mr. Gossi. Hi, Konstantin, finally. Happy to attend your presentations again. Yeah, I'm just wondering about the driver for the negative investment imbalance. Is it from the investment side, is it driven by mostly M&A or the greenfield types of FDI? And also wondering, would you say, what do you think about the licensing part also? Will it also contribute to this imbalance? Thank you.
Thanks. Very nice to see you, Sidan. Sidan was a student also in Mainz, and nice to have you in my living room, so to speak. Hope everything. You're in Kiel? Yeah. Yeah. So basically, most of that is really driven by FDI, right? I mean, generally, it could be driven by all sorts of cross-border investments. It could be government bonds, it could be portfolio investments, bank credits, etc. But empirically, the most part of that is FDI. But it doesn't matter if it's greenfield or mergers and acquisitions, right? Because in the end, these are payments on existing establishments, right? So in the end, it does not matter how the establishment came into place. The licensing part, of course, in my view, plays a very huge role, and this is exactly what we are seeing for the case of Ireland, right, that I showed you here. I mean, this is probably right. I mean, Ireland is selling services within a multinational. And this selling of services, if it's cross-border, generates a plus on the current account as a trade, as a service export, right? And then on the same hand, at the same moment in time, the revenue of that service export, right? That's export, which is just within a multinational. The revenue goes back to whatever is the owner of the FDI relationship, right? That's the profit outflow. That's the blue bar. By the way we book those things does not, I mean, this just because it's negative does not mean that the money is flowing out of Ireland. That's also important. That's also an important point that Piketty is missing. We always book FDI incomes as if they, so if a German invests in Ireland, right, as an FDI relationship, only for FDI, this is the case. Philippe Sauret has a paper on that. Then when the Irish affiliate makes a profit, we always book that as being repatriated. And even if it's reinvested, then it goes both ways, right? But like in the FDI statistics, we always treat that as if it would be dispersed in the first place, right? So the fact also that we see FDI profit outflows from Central Eastern Europe does not mean that the money is really leaving the country, right? Because much of that money is coming back in terms of reinvestments.
But continuing from the same question that Sidan made, so we are not sure what is there here that we see that the net negative investment income balance for Ireland. We don't know if it is FDI revenues that is a profit that is going back to the M&Es at home, or we don't either know if it is from government bonds, right? So if it is from an M&E who is investing in another country to again earn its own profit, returning it to its own pocket, that has been worrying, right? But because we don't know that, that's not that worrying, right? Is it the case because of the statistics, because we are missing something, we are not seeing the worrying part here?
I'm not completely sure. I mean, the worrying part, I think in both, I mean, does it make sense that we book this as a profit outflow, no matter if it's reinvested? I think it's right to book it that way, because in the end, this is not something which accrues in the end to Ireland, right? This is something that goes to Germany and then is being reinvested, right? I mean, that's the way to think about it. So I think like balance of payment compilers are right on that. Do we know what it is? Yes. I mean, I don't show you here. I could show you a graph where I really show you that almost 100% of the variation is driven by FDI across countries. We have those data. I mean, the Eurostat, you could break down by FDI and other asset classes. It depends a bit on what, on countries and time periods, but the details are available for Eurostat's data. And especially so if you go into national central banks, right? So if you look at, I mean, Austria has a very detailed breakdown. Germany, the Bundesbank has an excellent breakdown of bilateral, right? I mean, we could really go down into bilateral FDI payments from Austria or from Germany to any other, especially to other Euro area, other European countries. The quality of the data is quite good. Right? One could go into this detail.
So the reason that I'm saying worrying is because Piketty also highlighted it. That's why I was saying worrying. But maybe it is not worrying because such kind of FDI is generating jobs and generating value added, which is more important than shifting the profit from Ireland to the home of the FTA, right? So why should, I mean, it's an important and critical issue. So how should we look at it? Should we look at it as a good thing? Should we look at it as something that should happen at the end? I mean, because you gave an interesting policy recommendation at the end that for the Euro area, current account balances, and especially this investment income balance should matter. So is it good or is it bad? Is it worrying or is it not worrying?
Very good question. I have no answer on that. I was like, when I presented that at the central bank, right, they were mostly like, oh, but FDI is so good and generates job and stuff, right? And I was like, yeah, but also vulnerabilities, right? Here now, I hear a lot about vulnerabilities. I'm defending also. So I think there's no clear-cut answer. I think we should be aware of it. That would be for sure my interpretation, right? I mean, the problem I'm seeing is, yeah, I mean, if it's reinvested, fine. But we should be aware, like I think each country should be aware of its foreign asset position on a gross basis and should know what's in there, right? For example, Ireland, in order to be aware, how quickly can I see an outflow of things, right? Remember the tax cuts by Trump, right? So the US corporate multinationals had parked a lot of generated profits in tax havens and in other countries. And then Trump kind of gave a tax credit to those repatriated profits. And we saw a lot of like funds flowing back, right? And as a country which has a volatile position or a vulnerable position in its balance of payment, you have to be aware of that, right? So even though the money is so far technically staying in Ireland or in Eastern Europe, the question is, will that be the case? Especially, I think in Eastern Europe, remember, I mean, a lot of FDI is actually banks, right? So things are more volatile maybe there also.
I see. Dirk, you raised your hand.
Yes, so very interesting paper, Konstantin. Thanks a lot. And I will want to think a lot more about this. I want to ask a question about what you said about worrying. It doesn't have to be so worrying. So we really need to go back to basics. The reason we worry about imbalances is that countries, so we think about countries then as units, and you go beyond this, but then you also need to change or go back to the basics of the reason why we worry. If we think about countries as units, the reason to worry about imbalances is that a country can run out of foreign exchange. That's the basic problem. Now, in the case of let's say FDI, are we still facing the same problem? If we have intra-multinational exports and investment flows which are reinvested and so on, how is that connected to the risk that the country will run out of foreign exchange? These multinationals have their own access to the Eurodollar markets. They won't run out of foreign exchange. And if they do, does that create a problem for the country, or does it only create a problem for them? So I really appreciate and I welcome the shift from thinking about country level to thinking about firm levels and breaking down the current account into trade and income accounts and linking it to the investment account. But then we also need to do the other part of the work and say, so what does this mean for the policy implications? And do we still need to worry so much about these multinational related flows? Because they have their own financing options. It's not as if they completely must rely on the host country central bank for an exchange reserves. And so you really are in a different debate. What do you think?
No, thanks. Thanks. I think that's exactly where things get really interested, right? Really interesting also, right? I mean, think about the following case. Think about a huge German investor, some automobile company in a relatively small Eastern European country. I don't know. Let's call it
Czech Republic, Volkswagen.
Czech Republic, yeah, Czech Republic. Okay, also, yeah, so Slovak Republic, I think, even has a shallower capital market, right? And you're making profits there, right? I mean, of course, you're a very competitive car maker. You're making profits there, and you think like, oh, I want to keep the profits in Slovak Republic because actually I want to expand there. So I put, I have my Škoda affiliate in Slovakia, and it's making a profit. It's booked as a repatriated and reinvested, right? And in order, we have many multinationals or big firms that are over liquid. For now, I park that in the banking system in the Slovak Republic. And then I decide, well, things are really now changing, and really I now want to start investing that money. I have to pay down something in Germany, or I want to invest in Mexico. I'm now taking out of Slovak Republic all the money I'm having there. Right? This is in my view, that's a vulnerability to the system there. So we should be aware of how likely this event is. And by the way, it doesn't matter if the foreign country is a Euro country or not, because we saw, of course, that these things with the target imbalances still and the banking system still matter in currency union, right? In my view. So I think this is really where the debate is getting like super interesting. Like, I mean, are we on the same board that this is a potential threat?
Yeah, but what when you say when the car maker takes out his money, go to another country, is there really money taken out? They would either close down the plant there. Or
we don't even have to close down the plant there, right? Just assume that they're making profit there.
They would stop reinvesting the profit
in a bank account in another country. That they just leave it in the bank account. Then it goes into the banking system. The banking system takes the money and lends it to house owners or house buyers, right? And you have all sorts of transactions that you're more balance sheet things that you're more aware of than I am. The question is, of course, is the scenario I'm describing here a likely one?
Yeah.
And therefore we don't know enough. I think like it will be very interesting. The European Central Bank now has this project on the sector accounts, right? The financial accounts. If you link those, if it's possible to link those to the cross-border investment positions, I think there things get very interesting. There's a recent paper by Jakob Capella and also Michael Landesmann and co-authors on these on these trade imbalance reserve linkages. They don't have this particular challenge model that I'm talking about, but this is exactly what I think where things get interesting.
Yeah. And may I just note that Jan Kregel, for instance, has done work on this in the 90s on developing countries, or developing countries typically are treated as if they have trade account problems, but they really have income account problems.
Okay.
So if you impose structural changes to change the structure of trade, well, the real problem is in the investment account, right? You're not addressing the problem, just as you're saying now.
Okay,
thank you.
Maybe you can share the paper, Dirk?
Yeah, I will.
Cool, yeah. Thanks.
Okay, thanks.
Interesting discussion. So I have also some technical stuffs that I noted, which are, I mean, I don't know if I ask, but maybe it's better to ask because maybe other people would also see the need to discuss them. For instance, it starts with the beginning regression that you showed us. Why AR1? How did you get to AR1 instead of AR2 or any other thing like ARDL or any other things?
Yeah, no, I mean, definitely something that I think needs more work. It's just like my first, that's the first thing you can do it. AR4 would be a natural choice, right? For quarterly data, you could look at something like the coefficient of variation, absolutely, or error correction model. Yeah.
Then you showed the theta, which were coming from different models, and you compared them in one single graph, right? So can't you, I mean, we know that it's coefficients from different models cannot be easily comparable. So why not having everything in one single equation and having dummy for each country, and then that dummy should be interacted with the theta? Then you will get, from one single model, you will get different coefficients of, I don't know if it works in AR1 or if you need any other model for doing that.
Yeah, it's a bit tricky. I mean, I don't know exactly why you have a problem comparing those. I think the problem is a bit the trend also that we're having, right? So in a joint model, how would you then model the trend? Also country specific, but then we're basically in the same world as I can play around with that, but I don't think it will change the picture. Really the problem a bit is here that how to treat the trend of those balances, right? Because what I'm doing also is I'm including a trend that you see here.
Yeah.
And this can of course vary by country, right? I mean, you could also detrend by, but I think that all leads to the same, but taken. Yeah.
Yeah. And then, so you were dividing everything by GDP of the country. Why not dividing everything by GNP?
Because that's a convention, but like, to be honest, so that's what people usually do with current account balances. But I mean, I have always wondered, right? I mean, there's this whole debate about trade and welfare gains, and especially FDI. I have always wondered why people look at GDP, right? I've never clearly made that point, but of course, if you're like, take the case again, German FDI in Poland, right? Of course, that adds to Polish gross domestic product. I mean, everything else would be just plain stupid, right?
Yeah, but it's not.
But that's not the question. The question is, as you rightly say, and that point is very clear in the paper by Stephen Brackman and colleagues from Groningen that I mentioned. Actually, the relevant welfare indicator is GNI. No? Yeah. It's like what goes to local population and firms, right? It's not like value added that is actually going to abroad. Yeah?
So maybe it could be even the effect that you showed could be even stronger if you have it divided by the gross national income, right?
I have to think about it. Yeah, I have to think of what problems this creates, but yeah.
Yeah, for trade, it's okay to have it GDP, but for investment and income on investment, that's a different story, because that is not part of the GNP of the country, GNI of the country. And you had many variables in single equations. I was wondering if they had any collinearities. But I think some of them may be closely correlated with each other, especially in this one. For instance, real effective exchange rate with, I don't know, with Eurozone, with monetary policy. Yeah,
I fully agree. These are just like the things that that these two papers, Chin and Prasad, kind of suggested. I agree, but the main point there is really to say, look, these two columns here. So the middle column looks different from the right column, right? This is my main point there. I'm not particularly interested in how to exactly interpret the coefficient of M3. Yeah.
But that is even make it more interesting, because it's an interesting thing that you're showing here. And in order to be trusting the coefficient for savings and aging, we need to be sure that it doesn't have any collinearity with another variable.
Especially for aging, I fully agree. But let's remember what multicollinearity does. It just increases the standard errors, right? So yeah.
Well, if a variable is affected by another variable, it changes also its coefficient or its sign as well.
Yeah.
Yeah.
And more causal interpretation, but this is a detail. But I see your point. I agree. Yeah, I agree.
Yeah. And another point is the coefficient that you have, especially for the last regressions. How do you interpret them? I mean, these are very small, and if you want to, bring the notice of the policymaker, what would you tell them? Because this micro effect should have some significant meaning, or not. It's 0, 0, 0, 0, then 6, 8, 8. What does it tell us?
Yeah.
Yeah.
I think that's a very important point, especially for the policy debate, right? I don't know, to be honest, and I would hate that if I would hear it in a seminar, but I cannot tell you what the magnitude is, because I don't know the units here, if they're in hundreds or in percent. But yeah, that's an important point. How important, right? I mean, what I have shown you is that, I guess what I've shown you is that the relevance that these value chain participations do not harm your payment, investment income payment balance, right? But you're absolutely right. The question from a policy perspective is, well, if it's helping, then to what extent? Yeah. Thanks. Yeah.
So these were my comments.
To write a blog post on that, and by then, for sure, I will have the economic magnitudes.
Okay, anyone
and I will have
from the
figured out
audience?
In which direction the value chain is running. Thanks, Robert, also for pointing it out.
Yeah. Is any comment, question from the audience that were with us until now? Okay, if not, I thank everyone for joining this webinar, and next week we will have another webinar which will be again related to global value chains and the selection of countries in participation of their global value chains, which I invite you from now to register for this webinar. And I thank you all for being here. Especially I thank Konstantin for an interesting topic, an interesting and timely presentation for us, and other people for being available for discussions. So have a nice evening and see you in the future.